Good afternoon. So I'm seeing a few new names today, and these new names are again, I see Asraf, I see Tia. Asraf, Tia, have you attended any of my classes before?
Not really. I got the link today.
Or have you watched the recording?
Actually, I resetted my phone, so lost my WhatsApp backup, and there is only two messages shown in that group chat. That is today's lectures link, and then the link given for the lecture.
Yeah, I know that. But what I'm asking is, have you attended any of my classes, whether live, recording, whatever it is? You know me?
No, 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 no.
Like, okay, okay, fine. And then there
Like
is,
where to find the other? How many classes have there been before this?
I think this is our fifth class. So
So
the
do we have recordings for the other classes?
yes, of course, it is there. I mean, uh, we have shared all the details in the group, right? And if you don't have it, then you should definitely reach out to us on our hotline number and we'll share the details with you. I can, in fact, share the hotline number here as well again, just so that all of you are clear because FR, there are quite a lot of you who are doing FR with us. So the number is
Like on the group, Fin Chartered Academy, is that the number? +918148084134.
yes, yes, that is exactly the number.
Okay, sure, I will knock up.
Yeah. And are you attending the classes from India or where are you attending?
I'm from Bangladesh.
You're from Bangladesh. And have you done any of the ACCA papers before?
Yeah, I'm done with the skills, F4 and tax as well.
F4 and tax is done. Okay. Okay. So again, Azraf, Tia has watched. We only have classes on Tuesdays and Thursdays. We do not have Saturday classes. As of now, yes, because there is a clash with PM, the PM batch. So FR is something that we have already, just for your information, we're in intangible assets. And today, most likely, I will complete impairment. Okay. And just so all of you know, the first 10 minutes are spent in me asking questions. Teerth has also joined. Uh, so let me, this, Azraf, just make sure you watch the recording. So the first class, I completed these 20 topics which are in front of you. Then I did, this is the schedule. Class starts dot at 5:30. Okay. But just to ensure, like I heard from people that till 8, it's okay. Class till 8 is okay. After that, it's getting too much for them to sit through. So what we've decided to do is the second part, once you come back from the break, it will be till 7:50. So till the break, 6:55, we will have class till 6:55, and then 10 minutes we'll take a break, and then 7:05 to 7:50. So just second round is only 45 minutes. So you just need to sit with me for 45 minutes, and then 7:50 to 8, we will do the final review. This is the timetable. And I hope all of you are studying without fail. This is what we did on 25th of March. Then this is what we did on the 27th of March. And that's it. Oh, so technically this is only our fourth class. So 1, 2, 3, that's it. So this is only our fourth class. So for the fourth class, we are moving to the fourth chapter. It is reasonably good. Okay. So
Will we be able to sit for the June's exam?
yes, of course, definitely.
So when we'll we will finish the course
Mid,
syllabus.
Mid-May, I will finish the syllabus, but also from the coming week, we will also be uploading videos where we are solving exam kit questions.
Yeah.
So Kaplan, BPP, Study Hub practice questions, all of this we will solve for you.
And like CRQ,
Sorry?
CRQ questions.
CRQ,
Yeah.
what are you
Like
referring to?
section 3 questions, section C.
Yes, we will do all of that.
Okay, yeah.
Yeah, so we will be making content from this week itself, so you can start your kits from this week. Okay, the first question I would like to ask who, again, I'm not sure. Nityashri, are you there?
Yeah, I'm here. Yeah.
Okay, Nityashri, can you tell me what is um, cessation of capitalization? Just conceptually, what is it?
The question is, what is capitalization?
Cessation of capitalization. Here it is.
The capitalization, it ends when the money is not actually put into the use of the building the asset, or when it is not in the um, process of bringing the asset to the position when it is like to how it is intended to use.
Okay. So can you give me an example?
In case if the money is borrowed to build an asset, and when an asset is brought into a position where it can be used for what it is intended, and that is a point where you stop capitalizing the amount you borrowed.
So when you use it for the intended purpose, you stop capitalizing.
Yeah, when it is ready to be used.
Okay, you stop capitalizing when it is ready to be used. Okay, fine. Anyway, it is 5:40, and as per the rules, I have to start dot at 5:40. And guys, we were in the third chapter, and we had finished quite a lot. We had come even to amortization, and we had looked at R&D. Oh, we had looked at research and development. We had looked at test your understanding 1. We had looked at test your understanding 2. And now I'm going to look at illustration 2 on the 1st of April 2025. Improve has deferred development expenditure of 600,000 relating to the development of numerical brand X. So remember, this is a development expense. So again, for those of you who are new, let me just brief on research and development. Research and development, first of all, is not the same thing, right? Research is, for example, I will show you my screen. Okay. Research is where you go to a specific site. I'll use the same example that I gave last time, so it'll be like a quick revision for everybody. But what is research? Research is the study, the investigation on something. right? So research is the study, the original and planned investigation in order to gain knowledge. The investigation done on something in order to gain knowledge. For example, you study and see what is the cure for cancer. You see what chemicals work, what chemicals stop the growth of cancer. You are just doing the study, right? Once the study is over, you say research is done. Research is the study, the investigation on something. Development is once the study or once the research is over, can we sit hand in hand? Can we simply sit quiet? No, we cannot. Development is the once you've understood from the study, once you've got knowledge, you have to apply that knowledge in order to benefit yourself, in order to build something, in order to have the product ready. So once you have studied what works for cancer, what doesn't work for cancer, what prevents it, what cures it, once the study or research is over, development is the application of the knowledge in order to plan or design or build something that is improved product, that is an improved product. Okay, so research is the original study and development is the application of the knowledge from the study. So many people think it's the same thing, but definitely it is 200% not the same thing. Okay, so research and development, and again, what's your name? Azraf, make sure that as soon as you get the recordings, you watch them and you're clear with the difference between research and development. Okay.
Yeah,
So
sure. Actually, can I join like later on after I watch the recordings? Because I am not getting what is the
yes,
thing.
you can definitely do that. Once you've watched all the recordings, you can join live.
Like only 3 classes I have to watch the recording, right?
Just 3 classes.
Okay, yeah. Then if I knock you in that number, will I get someone to contact me now?
Definitely, yes.
Okay, sure. Then I will join later and I am not.
Yeah. So I've just summarized on what is research and development. Now we're going to look at illustration 2. It is expected that demand for the product will stay at a high level for the next 3 years. Annual sales of 400, 300, and 200,000 units, respectively, are expected. Brand X sells for $10. How should the development expenditure be amortized? Now, first of all, why are we amortizing? Amortize means what? It is the same as depreciate, but it is like depreciation. But for which type of assets? Intangible assets. It's for intangible assets. Okay, and I told you development is something that you will capitalize. Okay, so what do you have to look at? How much is the development expenditure? First thing you have to look at is how much is the development expenditure? First question to ask, how much is the development expenditure? How much is it? Who can tell me? Teerth, can you tell me? Kenny, How much? Look at the question. Tell me how much is the development expenditure? See the question. Improve has deferred. Very good, Hitansh. It is
600,000.
600,000. This is capitalized, yes. This has been taken as development. So we have development worth of 600,000. But now it needs to be amortized. And how do you amortize? Remember, it's like saying that I have a car worth 600,000, but there will be wear and tear, because of which there will be a drop in the value of the car. This is what depreciation is. But again, development is an intangible asset. So this 600,000, although we have development worth 600,000, any development, you will have to amortize it. They're basically saying that there will be a drop in the value of this 600,000. The easiest way to look at it is that this development is going to give us fruits for the next 3 years, meaning that this development is a development for the next 3 years. So again, what is the duration of the benefit of development? It is 3 years. So what we will do is 600,000 we can easily amortize over 3 years. So duration is 3 years. So 600,000 divided by 3. So the yearly, so say if you amortize 600,000 over 3 years, the yearly amortization will be 600 divided by 3, which is 200,000 will be the amortization per annum. Guys, any problems with this? Is this completely clear and easy? Is there any issues with this? Kenny?
No.
Let me know. All okay? Quickly? Yes. Now we will look at, yes, Kenny. Very good, Teeth. You covered recording. That is great. Excellent. As long as you're understanding, just let me know if there's a problem with understanding. Okay. The other way to kind of amortize, I will explain this to you with a small example. Okay. And it's like this. It's like, well, I have, say, an asset worth 600,000, or say, forget 600,000. I have an asset worth 10,000. Okay. And it was, say, it was this lecture you leave. Why? Oh, you haven't watched the previous recording. Please watch it. I have an asset worth 10,000. Okay. And the thing is, yeah, thanks. The thing is, I have an asset worth 10,000 and oh my God, wait. Okay, thank goodness it is being recorded. I have an asset worth 10,000 and out of this, I'm using this asset for 3 years. Okay, and suppose this asset is a shoe. Okay, not 10,000, it's a shoe worth 1,000 rupees. Now, one thing you can do is amortize it equally over 3 years. First year, 3,333.3. Second year, 3,300, or say I'm using it equally over 4 years. So 10,000 divided by 4, the amortization per year will be 2,500. But the new piece of information is in the first year, I used the shoe every day. In the first year, I used the shoe every day. In the second year, I used the shoe only for 3 months. In the third year, I used the shoe only for 1 month. And in the fourth year, I hardly used the shoe. So it's not fair to amortize like this. It is not fair. This is not fair. You're amortizing equally every year. 10,000 is, sorry, whatever is the amount. Let's assume it's 10,000. 10,000 is the amount. It's an expensive shoe. It's a 10,000 rupee shoe. 10,000 is the amount. It is being used for 4 years. So the yearly amortization is 2,500. But this is not fair because first year you are using more. So obviously wear and tear will also be more. Amortization will also be more. For example, look at this question in what I'm underlining in red. The total sales because of the development was 400 plus 300 plus 200,000. The total sales because of the development was 400,000 plus 300,000 plus 200,000 is 900,000. But are we selling equally first year 300, second year 300, third year 300? No. So what we can do is see how much percentage of this development money that we got in the first year. Out of 900,000, in year 1, we got 400,000. So 400,000 divided by 900,000 as a percentage, how much is it? 400,000 divided by 900,000 into 100, how much is it? It is 44%. So what I can do is, I can amortize 44% of this 600,000 in year 1. 44% of 600,000 I will amortize in year 1. And 44% of 600,000 is 266,667. So instead of amortizing 200,000 every year, what am I doing? I am amortizing based on the percentage of return that development is giving. In the first year, I'm getting 44%. So I will amortize 44% of the 600,000, which is 266,667. What about year 2? In year 2, I'm making a sale of 300,000 and the total sale was 900,000. So 300,000 divided by 900,000 is 1/3, which is how much? 33%. 300,000. Guys, all of you, please sit with your calculator. Guys, all my batches, especially FM, PM, I get answers faster than me. FR is an easier paper, so I need answers fast. 300,000 divided by 900,000, how much, Kenny? 33%. So what I will do is I will amortize 33% of the 600,000 in the second year. 33% of 600,000 is how much? 33.33. Is 200,000. And what about year 3? Who can do year 3 and tell me? Fastest who can do? Hitanshu? What about year 3? How will you do year 3? Can we get the answer? Real quick. What is happening in year 3? Hitanshu says 133,333. But again, we want to amortize 600,000 for the third year. But remember, for the third year, 200,000 units are made as sales have happened out of a total of 900,000. So the percentage is 200,000 divided by 900,000, which is how much? 22.2%. So 22.22% of 600,000 I will amortize in the third year. Which is, yes, as Hitanshu mentioned, 133,333. Which is, again, if you total 266,667 plus 200,000 plus 133,333. If you kind of do the total, it will be 600,000. So there are two ways to do this question. The first one is the easiest way, which is 600,000 is the development cost. It is capitalized.
It's 6 o'clock.
Okay, and the duration is 3 years. So you amortize over 3 years. So what you do is 600,000 divided by 3 is 200,000. End of story. That is the first method. The second method is where you amortize based on the activity in each year. Right? So method 1, you amortize equally over the 3 years, and method 2 is you amortize based on the activity in each year. If first year is having an activity of 44%, then 600,000, 44% of the 600,000 should be amortized in the first year, and so on. So I hope illustration 2 is clear to everybody. With which chapter is over? That's it. This chapter is done. Okay. Now, what I will do is we move to the 4th chapter. So 4th class, 4th chapter. So we are up to, our speed is reasonably good where we are finishing 1 chapter on average per day. And today's agenda is by 8 p.m. I will definitely try to complete the 4th chapter, which is on impairment, cash generating units and all of that. Okay. Yes. So let's look at the 4th chapter. Yes, guys, I will try my best to complete the 4th chapter. So what does the 4th chapter say? The 4th chapter talks about impairment. What is impairment? When will you say that an asset is impaired? Impaired means what? Impaired means it's spoiled, it's not good, it's not up to the mark. You'll say, oh, your vision is impaired. Vision is impaired means what? Vision is not good. Now in FR language, what is impaired? When will you say something is impaired? Is this? Look, when you have an asset, that asset carries a value in your mind, correct? Forget FR right now, but just imagine any asset, your mobile, your laptop, your car, your bike. When you have an asset, just completely forget FR. When you have an asset, that asset holds a value in your mind, whatever it is, 50,000, 60,000, 70,000. So there will definitely be a carrying amount or an amount the asset carries in your mind. For example, this laptop that I'm using, in my mind, this laptop that I am using is having a value of 10,000. In my mind, this laptop that I'm using carries a value of 10,000. Right? Good to know. But now, do I want to simply keep this laptop in my, cupboard? No, I want to use this laptop. This laptop I want to use. And I want to recover benefit from this laptop, take benefit from this laptop. So again, forget FR, forget anything that we have seen till now. So far, all you need to say is when you have an asset, that asset carries a value in your mind. Okay, let's do this exercise. Think of any asset that you are holding, any asset. Can you all type in the chat box which is the asset that you're thinking about? Just type it in the chat box. Quickly, think of an asset. Let's do this exercise. Think of an asset. Hitanshu computer. Okay, I'll stick to computer. Machinery, building. I want you to think of an asset that you have. I doubt you have machinery with you, Nitishri. Okay. Sarah, I don't know. Building, maybe not. But just imagine your computer, Hitanshu. Right? Okay. Kenny has thought of his car. So computer and car. Now think of what value in your mind does that asset carry? Don't tell me, just think. How much does your computer, what value does your computer carry in your mind? According to you, how much is its value? Don't tell me, just think, take 2 minutes, think. Any number, 10,000, 15,000, 20,000. Have you thought of a number, guys? Just tell me yes or no. Have you thought of a number for your, yes, Hitanshu, you've thought of a number. What about others? Kenny, Nityashri, Sarah, you've thought of a number. Okay, good. Now, suppose I tell you that this asset of yours, no, don't tell me. Suppose I tell you that this asset of yours it has a value in your mind, whatever you have thought of it. But suppose I tell you, you are selling the asset to me, and you ask me, how much will I give you for that asset? And I tell you that I will pay you 8,000 rupees. Now, all of you tell me, what value did you have in your mind for your asset? Kenny had 10,000. What value, tell me now in your mind, what value did your asset have? See, Sarah, your building was having a value of 15,000. So in your mind, Kenny had his car valued at 10,000. In his mind, in Kenny's mind, his car was carrying a value of 10,000. Hitanshu 40,000. He was expecting, he felt that in his mind, 40,000 was the value of the car. Nityashri 25,000. Sarah 15,000. But when you are actually trying to sell the car, then you are getting how much? Only 8,000, which means, are you happy or sad? In your mind, you were saying, oh, I'll get 10,000, I'll get 40,000, I'll get 25,000, I'll get 15,000. All this is what you had thought of. I'm putting that in blue. But finally, you're only able to recover 8,000 from the car. Yes, Sarah, you are sad. And you say, what is this asset? I thought in my mind the asset had a carrying value or a carrying amount of 40,000, but I'm able to recover only 8,000. You are sad. It's not a good thing. And this is what impairment is. You say that this asset is impaired. Impaired means each asset will definitely have a carrying amount. Just like here in your mind, your computer had a carrying amount. According to you, in your financial statements, the asset will have a carrying amount. But how much are you able to recover from that asset? In this example, the amount that you are able to recover was only 8,000. Here in this example, carrying amount was, again, I'll take only one example. In this example, carrying amount was 10,000. So in your books, in your financial statements, your car had a value of 10,000, but you're only able to recover how much? 8,000. So you say you are sad. So carrying amount, oh, you were happy when you were originally carrying the asset, you said, oh, it has a value of 10,000. But when you're actually trying to use the asset to get benefit, when you're actually trying to use the asset to get money, you're only able to recover 8,000. Red is sad, so I'm putting it in red. This is impairment. So you say there is an impairment of 2,000. I'm putting it in black, it's burnt and gone. Impairment of 2,000. So you say an asset is impaired when, as you can see this, the carrying amount is more than the recoverable amount. When the carrying amount is more than the recoverable amount, you say that an asset is impaired. I hope we're all clear on that. Okay. Now let's zoom in slightly. So we will look at recoverable amount in more detail. What is recoverable amount? As the name suggests, When you have an asset, when you carry an asset, you don't just want to carry it, right? You want to use it. You want to use it and recover benefit from the asset. Think of any asset that you have, all of you. When you have a car, do you just want the car to be there in the garage? No. Yes, it will be there, you will be carrying it, it will have a carrying amount. I agree. In your financial statements, you will say my car is worth 10,000. But you don't only want to carry it, you also want to use the car. You also want to recover money from the car. You don't want to just keep it in the garage. There are two ways to recover money from the car. How can you recover money from the car? One is by using the car. So obviously when you use the car will help you earn. The other way by which you can recover value from the car is by selling the car. When you sell the car, you will be paid. So in order to recover, again, I will use my example to explain this, and I will use the example of my laptop to explain this to you. I have a laptop which is old now. I bought it in 2018. It's almost 7 years old. Right? In my mind, the carrying amount of this laptop is 10,000. But I can recover whatever I paid. Obviously, I didn't get this laptop for free, correct? I had to pay money. So I can recover money from this laptop in two ways. What are the two ways? Either I can use this laptop, take classes, and earn money and recover my investment, or I sell this laptop and recover money. Now, this is my choice. And I have personally decided to go with the first option. Basically, use this laptop and use it every day for the next 2 years and recover fully. Paisa vasool, fully take back what I invested in the laptop. Fully recover by using the laptop. So the two ways to recover from an asset, recover money from an asset, is use it or sell it. You will recover money from an asset by choosing the method which gives you more money. What I mean by that is, we all want money, right? Suppose by using the laptop, I will get 10,000, but by selling the laptop, I will get 20,000. What will I do? Use it or sell it? Who can tell me? By using it, I'll get 10,000. And by selling it, I'll get 20,000. What will I do? I will sell it. Very good, Sarah. Great, Hitanshu. But suppose by using the laptop, I get 10,000. But by selling it, I'll get only 3,000. Which, what will I do? Use it or sell it? Great. Sarah is the fastest today. In this case, I will use the asset because I get more by using the asset. So recoverable amount is the higher or greater of two things. One, value and use. Whichever is higher. If the value and use is higher, we will recover by using the asset. If the selling is higher, then I will sell the asset, and fair value less cost to sell is basically NRV. The value of the asset minus cost to sell is the NRV. Again, remember, recoverable amount you will do and you will recover from an asset by whichever is higher. If selling and getting money is getting you more money, you will sell. If using will earn you more money, you will use. So that's why recoverable amount is the higher of whatever value in use versus fair value less cost to sell. What is fair value less cost to sell? What is fair value? This is the fair price that you can expect to get for your laptop. Cost to sell is had to just do a small repair for your laptop, costed you 500 rupees. Cost to sell is any money incurred in selling the asset to the customer. For example, AC, if I want to sell, I have to dismantle the AC. And obviously, dismantling will not be free, it will cost me money. Fair value less cost to sell is known as NRV. So, recoverable amount is the higher of this use the asset, which is value in use, and the NRV, net realizable value, which is simply fair value less cost to sell. So basically, all in all, what your textbook is saying is when you have an asset, you want to use the asset and recover benefit from the asset. Right? If, as I mentioned, if the carrying amount is high and the recoverable amount is low, as I told you in your example, carrying amount was 10,000. You all said that you have a laptop worth 10,000, but I said you can only recover 8,000. I will only give you 8,000 rupees for your laptop. This means that you are getting lesser than what you expected, and therefore this asset is impaired by 2,000. So when will you say an asset is impaired? An asset is impaired when the carrying amount is more than the recoverable amount. So I repeat, asset is considered to be impaired when the carrying amount, or say rather when you can recover less than the carrying amount, meaning you are unhappy. So you say this asset is this asset, this is impaired. You are unhappy. When you recover less than the carrying amount, or in other words, carrying amount is more than the recoverable amount. I hope the first sentence is clear. The second sentence is recoverable amount. You will recover from whichever is higher, either using or selling. So recoverable amount is the higher of NRV and value in use. Whichever is high, that will be the recoverable. Let's try to understand this better by looking at illustration 1. And I'll explain A and B. C you can try on your own. Look at A. A has a carrying amount of 100. And what is the recoverable amount? Remember, I told you recoverable amount is the higher of net realizable value and value in use. Which one is higher, net realizable value or value in use for A? Quickly.
120.
120 is higher. So the recoverable amount is 120. So value in use is higher. Yes, Sarah. So value in use is higher. So the recoverable amount is 120. Now tell me, guys, we in our mind we are carrying the value for this asset at 100, but we can recover more. So are you sad? Is anybody sad? You are able to recover more than the carrying amount. No, we are not sad. In fact, we are happy. So here we can recover more. And when will you say an asset is impaired? When you recover less. Therefore, the first one, A, there is no impairment, nil impairment. So the asset A is not impaired. I hope that's clear. What about asset B? What is asset B? Asset B is here. Carrying amount is 125 and NRV again is the higher. So yes, value in use, exactly Hitanshu. So here the recoverable amount is 130 because we have to see which is higher, value in use or net realizable value. Value in use is higher, so recoverable amount is 130. So carrying amount for B is 150. Recoverable amount for B is 130. So you will recover less. Will you be happy if you are recovering less money? No, you are not happy. Right? So you will say that what is this asset? It's such a bad asset. There is impairment. Right? So impairment is what? Impairment, there is an impairment of 20,000, 20K, because it carries an amount of 150 and recoverable is 120. So impairment is 20,000. And try see, I want to see who gives me the fastest answer. Is there an impairment or no for C? Okay, everybody says Hitanshu feels that there is an impairment. Yes, Hitanshu is absolutely right. Everybody is absolutely right. Yes, in C also. Again, the ones who are watching the recording, please let me know if there's a problem with this. So we've also done illustration 1 and we've seen what impairment is. So today we've seen what? We've seen illustration 2 from chapter 3. We've seen what is impairment. We've seen illustration 1. We've seen, that's it. Now, which IAS guides us for impairment? Remember, IAS is a friend. And the IAS, the friend that guides you in impairment, is IAS 36. So IAS 36 comes and guides you with impairment. I hope this is clear and absolutely comfortable for everybody. Next comes external indicators of impairment. Now, this is a fairly interesting topic, and I'll start with internal and then do external. See, Let me show you my screen. Very good. I got my perfect example. I was just searching on Google. So this is an asset that we use. It's a treadmill. See this treadmill? Do you see any problem with this treadmill? Look at the screen of it. By seeing itself, you know that, oh, the screen is broken. It is damaged. So there is evidence of damage. So when there is evidence of damage, obviously, maybe it is not maybe, there is a sign, it is an indicator that this treadmill is impaired. So the first indicator of impairment is what again. First indicator of impairment is signs or evidence of damage. Next, look at this. Look at this treadmill. How are we using it? How are we supposed to use it? We're supposed to use the treadmill to run. But how are we using it? How are we using it? We're putting clothes on it. This is a sign or an indicator that the treadmill, maybe it is impaired, because obviously if it was fine, then you wouldn't be using it like this. So whenever there is a change in the way you use the asset, it is a sign that it is an indicator that it is impaired. So if one is indicator is evidence, when there is physical evidence of damage, there is a chance it is an indicator of impairment. Second is change in the use of the asset or the way the asset is used. When that change happens, you say that this is what? This is impaired. This is an indicator, this is a sign of impairment. The third sign of impairment is, say you're running on the treadmill and every now and then the treadmill stops. Is it supposed to stop every now and then? No, definitely not. Or suppose while I'm taking class, my laptop gets shut down automatically. This is also an indicator of impairment. You understand? So when the asset does not perform as it's supposed to, okay, the performance of the asset is worse than expected, then also it's a sign that maybe the asset is impaired. economic performance of asset is below expectation, then also it is a sign that that asset is impaired. Okay. What are other signs of impairment? Oh, okay. The value of the asset in the market is very low. So whenever you go out with your treadmill, nobody is ready to like pay much for it. Again, it means suppose I come to you with my treadmill, nobody is buying. Nobody is ready to pay me much. So another indicator of impairment is when market value of the asset is expectation. Okay. Apart from this, now increase in interest rates. This is something you would see in FM, but at your level, we're not really required to know this in too much detail for FR at least. But in FM, we will look at discount rate used, getting the present value of the asset and all that. But FR level, in FR, you don't need to worry about it much. Right. Another indicator of impairment is say there have been changes in technology or market such that now it has a negative effect. Now, I mean, the technology is as such that you don't need a treadmill. You can, for example, not literally saying, but all you have to do is move your fingers like, in the motion of a treadmill, as if you are running on a treadmill. Just move two fingers, and that will do the work. It is as good as running on a treadmill. Once that happens, again, what will happen to the actual treadmill? Everybody will be sitting with their fingers moving like running on a treadmill. Right? And what will happen to the treadmill as such? Again, there will be impact. Here, the first three are signs that you will get by looking within your office. I mean, to see if your treadmill is impaired, you first three are you have to see within, inside. In your office itself, you will know. In your house itself, you will know if your treadmill is impaired. Look at your treadmill. See if there's any evidence of damage. Again, you don't have to go outside. So this is internal. No need to go outside to know this. Change in the use of the asset. Just look at your treadmill. Are there clothes on it? Is the way that you're using it, is it changed? If yes, then again, it is an indicator that it is impaired. But again, you don't need to go out. You just have to look internally. And see if the treadmill is stopping every now and then. Again, no need to go out in the market, no need to ask other people, no need to look outside the house. You have to look in your house itself. So the first three are internal indicators of impairment, and the next two are things that you will understand, are signs that you will get from outside the organization. What is the market value? This is outside, so it is external indicator. So what I've marked in red are internal indicators, and what I've marked in green are external indicators of impairment. Okay. I hope that is clear and absolutely easy. Next thing we're going to look at is test your understanding 1. Again, just read the question. An entity owns a car that was involved in an accident at the year end. Okay, fine. It is barely usable, so the value in use is estimated at 1,000. So the value in use is very less. Value in use is only 1,000. However, the car is a classic car and there is a demand for the parts. This results in a fair value less cost to sell of 3,000. So NRV is 3,000. So guys, what is the recoverable amount? 3,000 or 1,000? 1,000 is the value in use. 3,000 is the NRV. So what is the recoverable amount? So recoverable amount is whichever is higher. Sarah, how much recoverable amount? Okay. By using the asset, you'll only get 1,000. But if you sell it, you'll get 3,000. So you will sell it and try to recover 3,000 instead of recovering 1,000. So the recoverable amount is the higher of value in use and NRV. So the recoverable amount is 3,000. The opening carrying amount was 8,000 and the car is estimated to have a life of 3 years. So think about it. Carrying amount. So I know already what is the recoverable amount. It's 3,000. There is no debate on that. But I need what? I need the carrying amount. Again, how do I calculate the carrying amount? We've already done this in previous classes. I originally bought the car for $8,000. And obviously the car will depreciate. The car was originally bought for 8,000 and then there is a depreciation or wear and tear in the value of the car. This car had a life of 8 years. So the yearly depreciation was 1,000. Think about it. If 8,000 is depreciating over 8 years, the yearly depreciation will be 1,000. The yearly depreciation is 1,000. Okay. So think about it. You bought the car that was involved in an accident in the year end, that is in the first year end itself, the car has gotten into the accident. So the carrying amount of the car, only 1 year has passed. So we will depreciate only for 1 year. So total depreciation will be only 1 year depreciation. Yearly depreciation is 1,000. So the depreciation for 1 year is 1,000. Common sense. Total depreciation till date is only 1,000. I'm removing the original calculation, but the total depreciation is 1,000. So the carrying amount of the car was 7,000. Now think about it. You need only 2 figures. Carrying amount, recoverable amount. You are able to recover less, so you are unhappy about it. So you will say that this car is impaired and the impairment is of $4,000. And therefore the answer is that there is an impairment of 4,000. Guys, I hope this is clear. There is no problem at all. Tara, Nityashri, Kenny, Hitanshu. I hope this is absolutely clear. Again, there is an impairment. See, recoverable amount is less than the carrying amount. So you are unhappy. So there is an impairment of 4,000. Okay. Now let's look at test your understanding 2. An entity owns a property that was revalued to 500,000 on the 31st of March 2023 with a revaluation gain of 200,000 being recognized as other comprehensive income and recorded blah blah blah. Okay. So look at the question. The question says, what is the amount of impairment and how should this be treated? Again, an entity owns a property that was revalued to 500,000 on 31st March, and there was a revaluation gain of 200,000 being recognized. At 31st of March 2025, the property had a carrying amount of 460, but the recoverable amount of the property was estimated at 200,000. So, this is such a direct question. Think about it. Forget all this. Carrying amount is how much? 460,000. But you can only recover 200,000. Recoverable amount is 200,000. So there is, again, you can recover lesser. So you are unhappy. So there is definitely an impairment of how much? Who can tell me how much is the impairment? 460 minus 200,000. So the impairment is 260,000. I hope everybody is clear with test your understanding 2. Okay. Very good. Absolutely right. Okay, the next thing that we will look at is the reversal of an impairment loss. What do I mean by this? See, sometimes, okay, let's just look at the real life, our real life. Sometimes you might feel that what was the thing that we were using? Your treadmill is impaired. Oh, it's not working. It's not starting. So you will be very disappointed. You'll say, oh, it's gone. But then your brother, your sister, your mother, father, friend comes and starts it. It actually turns up. It actually starts. So originally, when you said that the treadmill is impaired, you had declared it impaired. But later, when somebody else went and tried, it's just working normal. So whatever you had said was impaired, you are reversing it and you're saying, no, it's not impaired. See, you're removing the impairment. Has this ever happened in your day-to-day life, guys? Something you felt was impaired and then you realize, no, it's not. The situation is better. You can use the asset. Has this ever happened with you? It does happen, right? So again, what you need to look at is once you kind of tag an asset as an impaired asset, what you need to do is every year you need to review the asset. Just like how if your mobile is spoiled and you say that it is impaired. But what will you do? Every now and then, you will try to switch it on. You will review it. See if there's any change. See if with hope you try to switch it on every 30 minutes. Maybe it will turn on. Same way, every reporting date, you will do a review. I hope the first point is clear. Please make a note of that. Now, how do you treat the impairment? Let's look. I will explain what is written in the other 3 points with the help of this illustration too. Boxer purchased a non-current asset on the 1st of Jan at a cost of 30,000. At that date, the asset had an estimated useful life of 10 years. Boxer did not revalue this type of asset but accounts for it on the basis of depreciated historical cost. At the 31st of December 2022, the asset was subject to an impairment review and had a recoverable amount of 160,000. At the 31st of December 2025, the circumstances which caused the original impairment have reversed and are no longer applicable, with the result that the recoverable amount is now 40,000. So explain with supporting computations the impact on the financial statements. Again, we purchased it on the 1st of Jan. And the cost was 30,000. So we look at it from day one. The original cost of the asset was 30,000. There is absolutely no problem. Right? And obviously, the asset will depreciate. How much was the life of the asset? 10 years. So if you have to depreciate 30,000 over 10 years, 30,000 wear and tear over 10 years means that the yearly wear and tear, the yearly depreciation is 30,000 divided by 10, 3,000. That is the yearly depreciation. This is the annual depreciation. So the total depreciation is, think about it. At 31st December 2022. So until 31st of December, there was no problem. So we will depreciate until 31st December 2022. So Jan 2021 to 31st December 2022 is 2 years. Jan 2021 to 31st December 2022 is how many years? 2 years. What are the two time periods? One is Jan to December 2021. The second is Jan to December 2022. So there are two time periods, so 2 years. So if the yearly depreciation is 3,000, the depreciation for 2 years will be 3,000 into 2, which is 6,000. So by the end of 2022, this asset had a carrying amount of how much? 30,000 was the cost. Total depreciation was 6,000. So the carrying amount at that date was 24,000. At 31st December, the asset was subject to an impairment review and had a recoverable amount of 16,000. Tell me now, guys, with what we have seen, is this asset impaired or not impaired? Carrying amount is 24, but you can recover 16,000. Impaired. And how much is the impairment? Impairment is 24,000 minus 16, $8,000. And again, remember, impairment is not something that we are celebrating. We are losing out. So you say it's an impairment loss. Okay. Then the circumstances on 31st of December 2025, the circumstances which caused the original impairment to be recognized have reversed and are no longer applicable. So now what will happen is in 2025. Okay, guys, it's 6:54. Basically, in the next few seconds, your break will start. So I want you to be comfortable with this much. And then post break, we will come back. We will complete this sum and we will move to cash generating unit, which is the last topic of the fourth chapter. Meaning that once we finish that, we can move to our fifth chapter. Fifth chapter is on what? Non-current assets held for sale. This is a very easy chapter. See, it's hardly 2 pages. So before Thursday, I want to be in the sixth chapter. And in your textbook, guys, there are how many chapters? 25. So by Thursday, if I'm in the sixth chapter, we are fairly good to go. I mean, our speed is reasonably good. So you don't need to worry about Saturday because even with 2 days, we are kind of like not very lagging behind. So we have about 20, technically 22, 23 chapters. The last two chapters are appendix. So technically 22 chapters are there. And if I complete 6 chapters by this week, that will be great. Okay, anyway, come back from your break at 7:05 sharp. Okay, thank you. Don't leave the meeting, stay in the meeting. Yes, guys, it's 7:05 p.m. Time for us to continue. Okay. And now what we're doing is we're going back to this example. Guys, are you all back? Just let me know in the chat. Again, just 45 minutes. You don't have to spend too many hours with me now. Just 45 minutes and we'll be done. Let me know in the chat box that you're back. Hitanshu, Kenny, Nityashri, Sara. Just type in the chat box and let me know. Yes, thank you. Hitanshu, Kenny, Nityashri is not there. We will now continue. All right. Now see, we've done until 2022 end. But on 31st of December, the circumstances which caused the original impairment to be recognized have reversed. Okay. And, there is no impairment. What you have to understand is the recoverable amount was 16,000 in 2022. So we will say that the asset is valued at 16,000 because that is how much you can recover from that asset. And this we're talking about 31st of December 2022. 16,000. Then what happened? 2023, 2024, 2025. 3 years there was depreciation that was happening. So you will have to definitely depreciate the asset for 3 years. Right? Now, again, remember this. Out of 10 years, 2 years were already over. So out of 10 years, 2 years were already over. And meaning from if out of 10 years, 2 years were already over. Why? 2021, 2022 I've already done here. So 2 years are already over. So out of 10 years, if 2 years are over, 8 years are pending. 10 minus 2, 8. And here we are depreciating for 3 years. So we are depreciating for 3 out of 8 years. But anyway, 8 years of depreciation is what is pending. Right? Now, obviously, remember the asset was written down to 16,000. So 16,000 will depreciate over 8 years. Now you might ask me, why is 16,000 being depreciated over 8 years? Is because last time, again over here, in this scenario, we got to know that the recoverable amount is only 16,000. So we said in our records that no, the asset is not 24,000. The asset is 16,000. So now the new value recoverable amount was 16,000, and that if it's depreciated over 8 years, 16,000 divided by 8, yearly depreciation will be 2,000. This is the yearly annual depreciation. And if the yearly depreciation is 2,000, then the depreciation for 3 years will be 2,000 into 3. So the depreciation is 6,000. So from 16,000, if 6,000 is being depreciated, the carrying amount of the asset on 31st December 2025 is 16,000 minus 6, 10,000. The carrying amount of the asset is 10,000. But what did we say? We are saying that the carrying amount is 10,000. And the question says that the original circumstances have been reversed, and are no longer applicable, with the result that the recoverable amount is 40,000. So the carrying amount is 10,000 in this case, and the recoverable amount is how much? 40,000, meaning again, go back to the original rules that we saw. The carrying amount is 10,000, but we can recover more. So there is no impairment, zero impairment. You understand? So what is happening? For now, that's all. I will look at one more thing, but as of now, this is all. So this was the original cost of the asset, 30,000. The yearly depreciation was 3,000. 2021 and 2022, 2-year depreciation was 6,000. So the carrying amount was 24,000. And we got to know that the recoverable amount is 16,000. Because we can recover less, there is an impairment loss of 8,000. Then what happened? 22, we wrote the asset to 16,000, and the yearly depreciation was 2,000. So 22, 20, 23, 24, 25. 3-year depreciation will be 6,000. So 16,000 minus 6,000 is carrying amount 1,000. Carrying amount, yes, it is 10,000, but now the textbook says that the recoverable amount is 40,000. So there is no impairment. So now what we can do is come back over here. I told you impaired assets should be reviewed at each reporting date to see whether there are indications that the impairment has reversed. Now, this is the point that I wanted to explain. Because the second point is very simple. A reversal of impairment is recognized immediately as income. Why? Because before you said that, oh, impairment is there, meaning we're losing money. But now what are we saying? Now we're saying the impairment has been reversed. So it's like an income. It's like we're getting back what we lost. It's like saying your mobile was not turning on. So you said, oh, it's a loss. I've lost everything. But suddenly if it turns on, it's like a gain back. It's like an income. So if there is a reversal of impairment, it is recognized as an income. So second paragraph is very common sense. However, the reversal must not take the value of the asset above its historical depreciated cost. So you can reverse back, but that reversal cannot be more than the value the asset would have if there was no depreciation. I will make that simpler for you, right? But what am I trying to say? Yes, there is a reversal. Yes, there is a good news. So it's like you said that the value of the asset is brought to 10,000, right? Originally, you said the asset has a value of only 10,000. But now there was a reversal. And now the asset is now valued at 40,000. But the reversal must not take the value of the asset above its depreciated historical cost. Meaning that is the third part that we are going to do now. And I will explain what that means. Right? Think of it this way. let's go back. It's like, you know, going back, flashback. Imagine this is a movie, we're going back in flashback. The asset originally costed us 30,000. Originally, go back, everything, flashback. Originally, the asset costed us 30,000. Now we will do this question assuming there was no impairment at all. Meaning that the original cost of the asset was 30,000. Of course, there was depreciation. Going back again, going to this part, going to depreciation, everything flashback. 30,000 copy paste. Annual depreciation, 30,000 will depreciate over 10 years. So the yearly depreciation is 3,000. Flashback. However, this time there is no impairment. Last time, what had happened? At 31st December 2022, there was an impairment. But this time, what are we saying? This time, we're saying there is no impairment. Absolutely no impairment. So now we will just depreciate the asset as normal until 2025. So what we will do, excuse me, I've opened something by mistake. I see new participants who are not there in the first half. Guys, as much as I would want to welcome you, the ones who are joining now, please make sure that you watch the first part, the recording. If there was no impairment, what would happen? We would, as usual, depreciate the asset for 5 years. So the total depreciation would be, so what will happen is, this which happened last time would not have happened. That is, in 2 years, we had an impairment, right? This 2-year story would not happen. Because this time we're assuming that there was no impairment. So this time we would depreciate normally for 5 years. And 3,000 if it's the yearly depreciation. For 5 years, it will be 15,000. So if there was absolutely no impairment, the asset would have had a carrying amount of how much? 30,000 minus 15,000. There would have been a carrying amount of 15,000. So if there was no impairment, the asset would have a carrying amount of 15,000. You got this piece of information, right? Now coming back to present day, flashback is over. We come back to the present day. And present day, we realized that the recoverable amount is 40,000. So there is no impairment. In fact, we can add back the gain. There is a gain of about 30,000, right? Because we are saying on 31st December that the asset is valued at 10,000. But on 31st December 2025, we are saying that there is, we did a review of impairment and the asset is valued at 40,000. The recoverable amount is 40,000. So there is a jump of up to 30,000. 30K jump is there. So there's a gain of about 30,000. However, the problem is, yes, there is a gain of 30,000, but you cannot add back 30,000 to the value of the asset, because even if there was no impairment, the carrying amount would only be 15,000. So the max to max you can add back is what would be the value of the asset if there was no impairment. So think about it. As of now, as of today, the carrying amount of the asset is 10,000 and we can reverse the impairment, but we can reverse it only to the total of 15,000 because the asset would have had a value of 15,000 if there was no impairment. So we can only reverse up to 15,000. So the reversal will only be for how much? Up to 15,000 and it is already at 10,000. So if you want to reverse it up to 15,000, there is a reversal of about 5,000. Now don't worry, I'll explain this in brief again, this entire sum. But I'll keep everything side by side so that you can see. First step is what? First step is to see, I'll keep it small so that you can see. First step is Boxer purchased a non-current asset on 1st Jan 2021 at a cost of 30,000. Okay, very good. It had a life of 10 years. Okay, very good. And obviously 30,000, if it is being depreciated over 10 years, the yearly depreciation will be 30,000 divided by 10, which is 3,000. Everything was going smoothly. Okay, 2021 got over smoothly. 2022 got over smoothly. 2 years went in peace. But at the end of the second year, we got to know that there is an impairment. So only 2 years went in peace. So that's why we are taking only 2-year depreciation. This is what really happened, okay? So if the yearly depreciation is 3,000, 2-year depreciation is 6,000. So the cost was 30,000, 2-year depreciation was 6,000. So the carrying amount is 30,000 minus 6,000, 24,000. 30,000 was the cost. 2-year depreciation was 6,000. So the carrying amount is 24,000. Easy. Everybody is happy. Okay, that was the story. But what happened on this date, on 31st December, when the carrying amount 22, on this date, when the carrying amount was 24,000, we got to know that no, recoverable amount is only 16,000. So we got a bad news on that date, that we can only recover 16,000. So there was a drop. We can recover less. So there is an impairment. We realized this on 31st December 2020. There was an impairment loss of 8,000. This is what we got to. Then we continued our story as usual. And what did we do in the second scenario? So first scenario, I'm putting it in green. In the second scenario, what did we do? Not second scenario, continuation of the story. When we continued this story, in 2025 December, we got to know that the recoverable amount is 40. So what will we do is, in 2022, we got to know that the asset has a carrying amount of only 16,000. So in 2022 December, we said that the asset has a carrying amount of only 16,000. And now we will again depreciate normally. And remember, the asset had a life of 10 years. See here, useful life of 10 years. But out of that, 2 years are already over in this green story. So from 10 years, if 2 years are over, 8 years are left. And again, the story is continuing for 3 years because in 2022, the story stopped. And now we are continuing in red from 2023, 2024, 2025 until end of 2025. So the story is continuing for another 3 years. So 16,000 is the cost, and the depreciation will be for 8 years. So the yearly depreciation will be 2,000. If yearly depreciation is 2,000, 3-year depreciation will be 6,000. So the carrying amount will be, think about it, from 16,000. If 6,000 is depreciated, carrying amount will be 10,000. So now on that date, we got to know that the recoverable amount is 40,000. So there is no impairment. In fact, there is a gain. There is no impairment loss. This is what we got to know. So we are happy in the second story or in the second half. So first half of the movie, first before the interval was a bad news, but the ending was good. So there is a reversal. There is a reversal. What do I mean by the reversal? I'm putting it in blue. Reversal means that the asset, there is no impairment. See, before we had charged an impairment, we said that there is an impairment of 8,000. But now we got to know that the asset is actually having a value of 40,000. So whatever we said we've lost, we're actually gaining back. No, if it's a gain, it's not impaired. If it's a gain, it's like a gain. It's like you're getting back. You'll not say the asset is impaired. So the impairment is being reversed, you will say. So in the red story, what is happening? Carrying amount is 10,000. Recoverable amount is 40,000. So first of all, there is no impairment. Impairment is 0. But the old impairment that was there, that is also being reversed. As of now, there is no impairment. See, carrying amount is 10,000. Recoverable amount is 40,000. So we know that if the recoverable amount is more, there is no impairment. But even the old impairment, we can reverse. How much can you reverse is the question. And that is what marks the third part of this sum, which I'm doing on my right hand side. It is a little difficult for me to use this to put that on my right hand side, given that I have to put space until so long. But how much can I reverse? I cannot reverse entire 40,000. I cannot say, oh, now my asset is worth 40,000. How much? Yes, I am saying that the recoverable amount is 40,000, but how much will you reverse? How much will you say that there is a gain because of reversal? How much will it be? I will tell you. But in the third part, we are looking at a flashback or a situation where what if there was no impairment at all from day one? So we're looking at the entire story where there was no impairment at all. How would the life be? How would our life be? So our life would be so happy, right? Because the asset costed 30,000. See, we are redoing it. 30,000. Yearly depreciation even then would be 3,000. 30,000 divided by 10 years. Yearly depreciation. $30,000 divided by 10 will be 3,000. And this situation, we're assuming what if it had not happened? What if on 31st December 2022, there was no impairment? Why? Because we want to reverse it, no? So we want to assume, we want to imagine what if there was no impairment? If there was no impairment, we would continuously depreciate for 5 years. Which 5 years? 2021, 2022, 2023, 2024, 2025, 5 years until 31st December, we will depreciate because there was no impairment. Right? So the depreciation for 5 years will be 3,000 into 5, 15,000. So if there was no impairment, the asset would have had a carrying amount of how much? 30,000 minus 15,000. 30,000 minus 15,000 is 15,000. So if there was no impairment, even then the carrying amount would only be 30,000 minus 15,000 is 15,000. You understand? So even if there was no depreciation, even then the carrying amount would only be 15,000, not more than that. It would not be more than that. So if you are doing reversal, you can reverse impairment where the reversal is done in such a way where you get to this point. You cannot say, oh, I'm reversing my impairment, so I'm like, my asset is 5 lakhs. No, you can't. The reversal will happen only how much the asset would be valued if there was no impairment in the first place. So the reversal will happen only up to the point where the asset is now valued at 15,000, not. And already now it is at 10,000. So the reversal, as of now, it is for 10,000. And if there was no impairment on day one, the asset would have been valued at 15,000. So we can do the reversal for about 5,000. So this 10,000 goes back to become 15,000. So we are reversing how much? A maximum of 5,000, not more than that. Because even if there was no impairment, the asset would still be only 15,000. So maximum to maximum that we can reverse is 15,000. And that is what your textbook is telling you here. The reversal must not take the value of the asset above its historical depreciated cost. That is, the amount it would have been if the original depreciation had never been, if the original impairment had never been. So you cannot reverse more than this 15,000 because even if the original impairment was not recorded, the asset would not be valued at more than 15,000. So when you reverse impairment, the maximum you can reverse is up to how much the asset would have been without impairment. So the maximum reversal that will happen is for 5,000, not more than that. Why 5,000? Because as of now it's 10,000. It would have been 15,000. So the maximum reversal is the balance of 5,000. Are we all happy? Online, offline, everybody. Because I've showed it side by side. So no need to go up, down. It's all there. Go through this. I'm going to give, because this is something many people don't understand. So I'm going to give you 2 minutes to go through this and let me know if there's any problem. The third part is a little bit confusing. Okay. Fine. First part is clear. Second part is clear. What is the third part saying? I will give you an analogy to understand this. Okay. And the analogy is this. Say, let me think of an analogy, but just give me a minute, not even a minute, just give me a couple of moments to think, construct my words. Okay, it's a rather, you can say sillyish, but again, the idea is so that you understand, right? So the example is, say you are very fit and somebody is jealous of you. So what do? They attack you and they kind of make your legs injured. So before you were at this level, okay, again, there's no numbers, I don't want it. But now, because of this attack, I don't know how they attacked you, but because of this attack, now your level has, see, they've attacked you. They attacked you. Because of this attack, your overall level, your overall activeness, your overall uh, ability has come down. Because why? They've attacked you. Correct? You've come down. Right? But imagine there is one kind of like, a genie pops up and he says, I will grant you one wish. What is that wish? You say, I want my legs to be fine. So you say that you please reverse me, make me back to my form. You make me like how I was before. So he grants you that wish. And what he does is, there is a reversal. But that reversal will not be like this. No. That reversal will be how much you would have been today if the attack did not happen. Right? If the attack did not happen, you would be here. So you're just reversing the attack. You will not say that, oh, now I'm at this level because of reverse. No, that's not possible. You will just go back to your original glory. That's all. You will not cross it 5x and go. No. You're just going back to your original form. But yes, you're going back to your original form. But even in your original form, even if there was no attack on you, your overall capability, your overall, athletic performance, your overall desirability would even then slowly come down, even if nobody attacked you. Why? Because of age, correct? Even if nobody attacked you, your overall athletic performance, your overall desirability even then it would come down because of age. So gradually it would come down even if nobody attacked you. Nobody needs to attack you. Even then, it would gradually come down. Right? So what we are saying here is, if nobody attacked you also, gradually, look at my eraser. I don't know if you can see it. But see gradually, gradually your overall athletic performance would have definitely come down, not because somebody attacked you, but because of age. This part is removed, this part is removed, this part is removed, this part is removed. Even if nobody attacked you, your athletic performance would only be till here. Why? Because of age. So when the genie reverses you, the maximum that you can be reversed is back to how much you would be if there is no attack happening, after taking into consideration that, hey, you are also becoming older. And as you become older, obviously overall athletic performance will come down. Right? So the maximum the genie can reverse you is only this much part. Are you understanding, Hitanshu? Yes. So that's exactly what I'm telling you here. Yes, somebody has attacked you. See, they've brought you down. See here, just follow what I'm marking. They've made you impaired. Right? But now a genie has come and said that, hey, I will help you. I will reverse your impairment. But the reversal of impairment has to be reasonable. Even if nobody attacked you, your athletic performance would have definitely come down. Why? Because of age. So even if nobody attacked you, your carrying amount would only be 15,000. So the genie can only make you back to that form, 15,000 form, not more than that. And that's why, because of impairment, you are at 10,000, but without the attack, you would be at 15,000. So the genie can reverse you by 5,000. That's all, not more than that. Hitanshu, is this clear? 5 out of 5 now. And what about others? Sarah, Nityashri, Kenny, please let me know. Quickly, guys. Kenny is fine. What about others? Sarah, Jamri, Hitanshu, Nityashri. Hitanshu, are you okay? This 15,000 depreciation is calculated for 5 years. Yes, obviously. Calculated for 5 years. Why? Because if the genie had not attacked you in 2022, then you would depreciate without any brick. We stopped in 2022 only because there was a attack, only because there was an impairment. But if there was no impairment, 21, 22, 23, 24, 25, we would just continue depreciating non-stop. Hitanshu, clear. What about Nityashri? Nityashri, I am not hearing from you. Yes, thank you, Hitanshu. Kenny, thanks. Sara. Again, Nityashri, I haven't heard. So that is what this says. Okay. So illustration 2 is also done. The next thing and the last thing for this chapter is cash generating units. What do I mean by cash generating units? Say, uh, in my institute, I have 2 classrooms. I have 2 big screens. I have a team, of course. I have some desks. I have a lot of assets. But what is cash generating? Is in order to generate cash flows, in order to get cash flows, what is the smallest set of assets that I need? Basically, in order to generate cash flow, the smallest set of assets, I don't need all the assets to work together. The smallest set of assets I need in order to generate cash flow is just my laptop and my charger. If I have these 2 things, I can earn from anywhere in the world. So the smallest group of assets that are able to work together in order to get cash flows is a cash generating unit. So in my case, the cash generating unit would be my laptop and my charger. That's it. The smallest, again, see, in a coffee shop, there will be big coffee making machines. There will be equipment. There will be tables, etc. But you know that dispenser and the items inside the dispenser. You know, dispenser in coffee shops or in malls, generally you have like a small fridge. I show it to you. This one. Have you seen this? You just have to put in cash and that's it. It will generate cash for you. So forget the big things. Yes, in the coffee shop, there are so many assets, but the smallest group of assets that can work together in order to generate cash is a cash generating unit. So here you just need this dispenser and you need these things inside, and that will itself generate cash for you. So that is what cash generating unit is. Cash generating unit is the smallest set of group of assets that can work together in order to generate cash inflows. Make a note of that and let me know if there's a problem. So guys, fourth class, fourth chapter is coming to an end. Meaning that even if I stay at this space, we're fine. So again, it's 7:52 p.m. and these are the 7 topics that we've looked at. We've spent quite some time doing illustration 2. A decent amount of time was spent in doing illustration 2, which is why, again, we've done only 8 topics today. But in the next class, I will for sure complete chapter 4 and probably even complete chapter 5. And I'll try to move to the 6th chapter. Right? So again, last 8 minutes left. And I want you, this is the schedule that we are following on request from students. So 7:53 it is. To review what we've done today, in fact, we've uploaded the materials on the LMS 2-3 days back itself. So review it, and while you review it, I will take your attendance. Again, we can track how many classes have you watched, how many you're present, absent, which class, what, everything we can access here on our LMS. FR, log attendance. Hitanshu is present. We've got Kenny.
Yes, sir.
Just taking your attendance down. Because ultimately, see, we are here to support you, help you. And these are some things, basic things on attendances and stuff, because ultimately, all of this will matter. So these are the present people. Others watching the recordings, make sure that you're watching it in full and reach out to us if you have questions. I have never. Oh, thank you so much, Kenny. That makes a lot. It's like a boost for us because ultimately, as a tutor, you are happiest when the students are understanding. So again, For as long as you people are understanding and it is helping you, we are very happy. Well, about sums, again, the sums that I've practiced, you need to practice that, number one. But number two is, again, we are working constantly in order to improvise the overall experience for you. For example, every Friday, from this Friday, there will be a test without fail. Already a couple of batches, the tests have started. So see, all these students of mine, they've already submitted their marks. And I get a notification like this. So every Friday, there will be a test. And every week, we will be, again, due to the shortage of time, we will be making video content recordings where we open the kits, whether it's Kaplan kit, whether it's PPP kit, whether it's Study Hub practice questions, we will be solving that as much as possible. So that you don't need to start the exam kit after the syllabus is over. Again, I mentioned this in one of the previous classes. I'm not sure if I mentioned it in this batch, but I get calls from students saying in the last week of the exam, okay, one more week for the exam, and I get a call and the student says, "Sir, I've completed everything, only the kit is left." Now, I don't know what to tell you because kit, you don't say only kit is left. You say, I have the kit to do. It's a lot to do. Yes, that's why what we want is by the time the syllabus is over, you should be strong with the textbook, Kaplan kit, PPP kit, study hub practice questions, examiners reports should be done for you, articles should be done. So the kits, we will make recorded content and upload on the LMS. Okay, so I hope your rating is 5 out of 5 for today. Yes, of course. Definitely you have to practice. You will have to practice a lot. If you've given 5 out of 5, you can leave. If you've not given 5 out of 5, we need to sit and discuss. Okay. Thank you. Thank you so much, Tanshu. Again, we are here for you. All right. I will see you on Thursday. Okay, guys, you can leave. Thank you so much. That is all. See you soon. Yeah, bye.